A couple things that I feel unsure about with regard to Airbnbs.
Ooh, okay.
So Schedule C, that seems to be the consensus, or is that not the consensus?
Not for me. So the only time it would show up on a Schedule C is if they're providing substantial services. So just the fact that it's an average rental term less than 7 days doesn't make it automatically Schedule C. The substantial services is the important part. And by that, I mean, think like a hotel. The hotel comes in and makes your bed while you're still staying there. Most Airbnbs don't offer that type of service during the stay. They clean before and after, not during. Think of things like a bed and breakfast where you stay there and they have someone at the house who prepares breakfast in the morning. Some places will take you on tours where they literally like pile you in their car and they'll go take you on a tour. Those kinds of things are substantial services, and that leads to Schedule C treatment. But if they're not providing substantial services, odds are it's going to be a Schedule E. Now, where it will be a little different is on the depreciation. So if the average stay is less than 7 days, then it's a commercial rental that depreciates over 39 years instead of a residential rental that depreciates over 27 and a half. So that's important.
So let's say that it is substantial services, just for the sake of this conversation. So then let's say you're putting it on a Schedule C. That means then that you're avoiding the passive activity loss limitations and potentially able to take like a rather large loss against your other income, which can be appealing, right?
So Schedule E also does not mean that it's automatically passive. So if you materially participate in a short-term rental, then you qualify for the short-term rental loophole. That's a lower bar. Material participation is a lower bar than you would otherwise have to meet. So it can be on a Schedule E and still be considered non-passive and still not subject to loss limitations. Whole session just on the short-term rental loophole, and maybe we'll do that the next session, because I took a CPE course on that, like a webinar, and the webinar was 4 hours, but I can pretty much pare that down to the real meat and potatoes in our hour-long session. So that might be a great topic.
Interesting. So it's like, let's say your goal, again, just totally hypothetically, is to avoid the passive activity loss limitation. You can still have a way to do that on a Schedule E. Okay.
Yeah, and then you're not subjecting your client to unnecessary self-employment tax.
Right. So that's already worth the price of admission, as they say. So because you have a lot of people, a lot of clients, right, that are buying these that are higher income, Yep. So if it's a regular property, they're going to not really get, especially in the early years, like all this, extra losses and things that can really, go against their other income, right? So that's super helpful. So then with it being a commercial property, and with you mentioning that you were on a 4-hour webinar, so congratulations. What are your thoughts on like using some commercially types of accelerated depreciation, such as qualified improvement property and like Section 179 cost segregation, like ways to really like juice up deductions in earlier years? Do you think that's like legal, ethical, questionable?
I would think that it would be allowed, because that would be allowed just on a regular residential rental as well. So I don't think the rules, as far as doing like a cost seg, I don't think the rules on that change just because it's short-term versus long-term. The biggest difference will be that the things that you cannot accelerate will depreciate for a longer period of time, 39 versus 27 and a half. And that's an area that I see wrong on a lot of tax returns that come to me with Airbnbs. I see them depreciated for 27 and a half most of the time.
Right.
In fact, I'll confess, y'all, that I made that mistake with my very first Airbnb client. So just putting myself out there.
And lastly here is really helpful. So we talked a lot, and you talked a lot at the extravaganza event over the summer about like really getting focused on particular groups of clients like that have similar needs and like speaking directly to that group. So I feel like Airbnb and short-term rental is kind of like becoming one of those groups that's, So like, do you think for people on this call and just in general, is this like, do you see this as being like a really like growing client group and like a good client group to really market to and, you know, and provide services to?
I do. So real estate investors in general can make for a really good niche. You have to be kind of careful because especially if they only have a rental property or two, they tend to be very price sensitive, right? Because it's all about cash flow for them. But even if you're not so much getting into real estate investors necessarily as a whole tax niche, keep that in your arsenal for tax planning. So let's say maybe your niche is high net worth individuals. Maybe you don't want to do any bookkeeping. You want to specialize in tax planning and tax prep only. And let me tell y'all, you can build $1 million firm just on tax planning and tax prep. Very high level people if you focus on high net worth. And this whole short-term rental strategy is huge right now. Everybody's talking about it. If you get on the Bigger Pockets podcast, if you get on any type of real estate investor podcast or group, they are all talking about short-term rentals. So if you're trying to get into a tax planning niche, I would encourage you to study up on that strategy because it won't work for everyone. Like for me, for example, I'm not super high net worth, but I bought a short-term rental earlier this year. I'm not going to be able to take advantage of that loophole because I don't materially participate. I use a property manager, and so I won't meet the 100-hour rule. And when we have our session, I'll tell you the 7 rules for material participation and the ones people most commonly meet. One of them is the 100-hour rule. So I won't be able to meet that, and so my losses are going to be limited, which is a bummer. But there's no way around it. I can't self-manage a property that's 13 hours away. It's just not going to be a thing I can do.